Good afternoon, everyone. This is Group 7 for International Business course. We're here to present to you our case study titled Market Seeking Motives and Market-Related Promises and Actions in Foreign Direct Investment Privatization in Central and Eastern Europe. Application towards a Canadian company, Alkan. The team members on this project are Ayodeji, myself Collins, and Shavana. We shall take you through 6 parts of this presentation. The first would be an introduction where we'll tell you what the case study is about, then theoretical background on the case, research context and methods of the writers, research findings of the writers, then discussions around the topic, which is foreign direct investments. Then finally, we shall apply our findings to a Canadian company, Alkan Incorporated. So we'll start with the introduction by letting you know that this presentation explores the dynamics of foreign direct investments privatization in Central and Eastern Europe, focusing on the factors that drive successful partnership amongst foreign investors, host governments, and local companies. Drawing insight from the 7 in-depth cases studied in Bulgaria, the research highlights the critical role of market-seeking motives and shared objectives. It also speaks about the importance of aligning motives and expectations between involved parties. Then, how transparent commitments and realistic assessments of market potential influences the success of foreign direct investment ventures. Key findings suggest that when motives, promises, and actions align, the long-term outcome for privatized ventures are significantly improved. This study offers practical insight into enhancing foreign direct investment success in transitional economies through better alignment and transparency. Now I'll take you through theoretical background. Foreign direct investment privatization in Central and Eastern Europe emerged after 1980s as governments transitioned to market economies. By partnering with Western investors, these countries aim to accelerate economic growth, gain capital, technology, and expertise, and foster global market integration. Now, there were 3 main stages of foreign direct investment privatization process. Number 1 is pre-privatization. Here, initial steps to identify partners, understand motives, and establish compatibility among foreign investors, host governments, and local companies happens. The second stage is privatization. At this stage, what happens is negotiation of terms, formal promises, and commitments by each party, setting the framework for future relationships. Now, the third stage is post-privatization. And what happens here is the assessment of promise fulfillment, trust development, and alignment of actions with initial motives. And this impacts the venture's long-term success. In foreign direct investment relationships, motives, promises, and actions play a critical role in shaping successful partnership among foreign investors, host governments, and local companies. Here's how each element functions. For motives, each party enters foreign direct investment privatization with specific goals such as market expansion, access to resources, or economic development. Motives are foundational in aligning interests and understanding what each participant seeks to gain from the relationship. The second is promise. During the privatization negotiation, parties make promises based on their motives. For investors, promises might involve bringing in capital, technology, or market access. For host government, commitments could include favorable market conditions or regulatory support. These promises establish initial expectations among parties. Thirdly is actions. Now, after privatization, each party's action reveals their commitments to fulfilling promises. Fulfilled promises ensure mutual satisfaction, while unmet promises can lead to distrust and hinder venture success. Now, the market-seeking motives, promises, and actions of parties involved are as follows. For the foreign investors, they seek to expand local presence, protect and grow market share, and use Central Eastern Europe as a production and export hub to nearby regions. Their promises are market expertise, expanded access, improved local positioning, and quality brands, while their actions include staff training, leveraging networks, and product integration. For example, in the Republica case, Philip Morris promised to bring market expertise and improve the host company's market position. They followed through by establishing new marketing departments and providing trainings to local managers. Now, for the host companies, their motive is to gain marketing and management skills, assess high quality product strength, local market position, and expand exports. They promise market access and local insights, supporting entry and aligning with investor standards. Now, their actions include the facilitation of market entry with local expertise, collaboration on developing market strategies, and enhancing capabilities in marketing and brand management. For example, in Kamenica, the host company promised to help improve the market position by utilizing its brand recognition. They took action by collaborating closely with Interbrew to introduce the foreign investors' marketing strategies while also maintaining the local brand presence in the market. Now, the host government's motive is to boost exports, build a competitive economy, introduce new products, enhance distribution networks, and gain marketing expertise. Now, they promise to export friendly conditions, domestic support, and reforms. Now, in order to action this, they reduced regulatory barriers for exports, implemented policies that encourage market competition, and provided incentives to attract and sustain foreign investment. An example of this is in the Zagoka case. The government promised to support market-led economic reforms to stimulate growth. They enacted policies that created a more competitive market environment and reduced trade barriers, which benefited both local and foreign investors. Now, here is a table representing how market-seeking motives and market-related promises of the host company and investor, as well as the host government, in the foreign direct investment privatization case in Bulgaria was handled. The numbers 1, 2, 3 shows the ranking of motives and promises in terms of importance, with 1 designating most important and 3 designating least important. Now we'll talk about the research context and method. First of all is the focus on foreign direct investment privatization case in Bulgaria. The study specifically examines FDI privatization in Bulgaria, a country that lagged behind other Central and Eastern European nations in attracting foreign direct investment during its transition from a centrally planned to a market economy. The paper analyzes how foreign investors, host companies, and governments interact in the privatization of state-owned enterprise in Bulgaria. Secondly is the quantitative approach. The paper uses a quantitative approach focusing on 7 foreign direct investment privatization cases in Bulgaria. It employs in-depth interview with key decision makers from foreign investors, host companies, and government, conducted over 3 rounds between 1995 and 1999. This method explores how motives, promises, and actions align or misalign, influencing the success or failure of privatization ventures. Now, how the cases were chosen. Cases were chosen based on several criteria. First is diversity, which represents various industries and foreign investors for a broad analysis of privatization experiences. Secondly is duration. Cases had progressed through all 3 stages of foreign direct investment privatization and were in the post-privatization stage for at least 3 years. The third is data availability. Now, cases had data from all parties involved through interviews and documentations. And the fourth one is real-world relevance. The cases provided real-time longitudinal examples of foreign direct investment privatization. These criteria ensured comprehensive and detailed insight into foreign direct investment privatization in Bulgaria's transition economy. Next is the use of triangulation. Triangulation in the study involves using multiple data sources and methods to validate findings. The researchers conducted interviews over several years between 1995 and 1999, and from different formats: investors, host companies, and governments, to cross-check information. This approach ensured the reliability and consistency of the data, providing a comprehensive view of foreign direct investment privatization process.
Research findings. We shall be looking into the three parties: the foreign investor, a study of the Organization for Economic Cooperation and Development (OECD) countries in 1994 shows the foreign investors' motive as ranked by 162 companies investing in Central and Eastern Europe. CEE: access to large domestic market, gaining market share, low cost production, and source of raw materials. Hence, market seeking motive has a major impact on investors investing in CCEC. For example, we have seen as foreign investors has targeted Czech, Polish, and Hungarian market in their domestic market. For the host country, according to Eurojec in 1994, two main motives dominate most companies' management decisions to attract foreign investors into privatization, which are finances as a means of survival and potential future growth. And finally, for the host government, at the macroeconomic level, their motives for encouraging FDI have often been synchronized with the motive for pursuing privatization programs. One of these relates to the desire to speed up transition to lead market economics, according to Marinov and Marinova in 2001. We have seen all these motives being played out in the market-seeking motive and promise in the FDI privatization in CE. The case reveals varying alignment between motives and commitment between case A and G. The high alignment between initial motive and actual commitment results in clear benefit to both the investor and host country in case A, where the investor had expatriate managers acting as marketing directors of the privatized firm, and where the marketing strategy and all the new brands were developed in the investor's headquarters, compared to case G, which represents a low alignment scenario where the anticipated benefits of the host country, such as job creation or skill development, remain unfulfilled as a result of investor prioritizing short-term profits and cutting costs. Importance of congruent motive, promises, and actions for sustaining trust. Congruence between motives, promise, and action is essential for sustaining trust in foreign direct investment. Where investors align their intentions with tangible commitment, they build trust with local governments and communities, enhancing their credibility. This trust encourages supportive policies and fosters a stable environment for long-term partnership. Consistency between promises and actions also reduces the risk of conflict, securing investors' operations and enabling growth. In short, alignment in FDI strengthens investors' relationship, boosts reputation, and ensures sustainable success in all countries. In foreign direct investment within Central and Eastern Europe, alignment between investors' motive, promises, and actions is critical for sustaining trust, achieving long-term success. Key insights include written commitment. Investors' formal documented commitment build trust by providing clear expectations, helping host communities feel secure in the investment dedication to local development. Risks of verbal promises: rely solemnly on verbal promises possesses risk without written commitment. Verbal assurance may not translate into actions, leading to mistrust if expectations go unmet. Market knowledge and expertise. Investment with deep knowledge and expertise in local markets are better equipped to make realistic commitments, which they are more likely to fulfill, ensuring their actions align with initial promises and fostering stronger relationships with local stakeholders. These elements together highlight the importance of clear, consistent, and documented commitment for effective, trustworthy FDI relationships. Background on Alkan International Privatization and FDI processes. Alkan International was a major global aluminum producer, originally a Canadian company known as Aluminium Company of Canada, Over time, Alkan expanded internationally, leveraging both organic growth and foreign direct investment to enhance its position in the global aluminum market. In the early 2000s, Alkan entered a significant phase of restructuring, which included a focus on privatization and strategic mergers and acquisitions to maintain competitiveness in a rapidly changing industry. Alkan has high-quality upstream asset portfolio with a sustainable low-cost position through its excellent access to long-life hydropower. As at 2007, Alkan's revenue is $25.2 billion. The chart shows Alkan's revenue and net income trend, showing a positive trend line from 2002 to 2007. Market-seeking motive, promises and actions, contributors among parties. The alignment of market-seeking motive, promises and actions between Alkan and Rio Tinto illustrates how multinational corporations navigate their foreign direct investment strategies and commitments they make to host countries. This primary market-seeking motive was to enhance their global presence in highly competitive aluminium and mining industry. Alkan, as a global leader in aluminum production, was motivated by expanding into new markets and securing access to critical resources, while Rio sought to diversify its portfolio and strengthen its positions in the aluminum sector. Through the acquisition of Alkan in 2007, Rio aimed to bolster its aluminum production capabilities, improve efficiency, and expand its market reach, particularly in emerging and developing markets. Promise made. During the acquisition process, Rio Tinto made several promises to ensure that the deal would be seen favorable both local government and employees. This commitment typically included promises of maintaining jobs, sustaining operations in key regions, transferring technology, and contribution to local economic development. Alkan had its own set of promises, particularly related to local investment in infrastructure, job creation, and improving community relations in the area where its plant operations were located. Actions taken. After the acquisition, actions taken by Rio Tinto and Alkan reveal the degree of congruence between their promises and actual incomes. Rio Tinto made significant investment in Alkan's operation, particularly in the development of new facilities and improvement in existing plants.
In Alkan's case, we can identify three stages in the FDI privatization process. First, in the pre-privatization stage, Alkan focused on finding an investor that aligned with its strategic goals, modernizing production and expanding access to international markets. Rio Tinto emerged as a top candidate due to its capital strength, expertise, and shared commitment to sustainable growth. The Canadian government was also involved, assessing Rio Tinto's qualifications to ensure the acquisition would benefit Canada's economy and align with national interests. Next, during privatization, Alkan and Rio Tinto established formal agreements outlining obligations to each other and to Canada. These agreements specified Rio Tinto's commitments to invest in Canadian facilities and uphold employment and environmental standards. Legally binding contracts helped set clear expectations and established mutual alignment among Alkan, Rio Tinto, and the Canadian government. Finally, in the post-privatization stage, Rio Tinto began delivering on its promises by investing in Alkan's technological capabilities and expanding its market presence. The Canadian government continued to monitor Rio Tinto's ownership to ensure compliance with these commitments, aiming to protect Alkan's contribution to the national economy and public interest. This structured three-stage approach set the stage for smooth privatization process and a successful transition to foreign ownership. Now I'll be talking about the comparative analysis of FDI privatization between Alkan and the cases in the research paper. I'll begin with the differences and then cover similarities in the area of motives, promises, and actions. For the first difference in terms of motive, Rio Tinto's acquisition of Alkan was driven by global market consolidation within the aluminium industry. Rio Tinto wanted to strengthen its competitive position in North America and globally. In contrast, the CE firms were privatized with a focus on economic restructuring and modernization, aiming to reduce public sector burdens and revitalize industries in post-socialized economies. The second difference in terms of promises, for Alkan, Rio Tinto's commitments primarily focused on maintaining Alkan's role in Quebec, with limited community commitments, such as the Rio Tinto Alkan Foundation. In CEE cases, investors made broader promises, including regional economic development and job creation. These commitments were designed to support economic stability and growth in the local regions. Finally, the difference in terms of actions. Post-acquisition, Rio Tinto streamlined operations by divesting Alkan's non-core assets, such as its packaging division, to concentrate on aluminium production. Whereas in CEE cases, investors typically retained assets and invested in infrastructure and technology upgrades to build long-term sustainable industries that supported local employment and economic growth. However, both of them have some similarities in terms of motives, promises, and government oversight. Both Alkan and the CEE firms attracted foreign investors who were motivated by market expansion and access to regional resources. Besides that, investors in both cases made commitments to job retention and community support to gain local support and address concerns around employment stability. Finally, in both scenarios, government oversight was involved to ensure investors followed through on their commitments. This regulatory oversight aligned investor actions with local economic goals and interests. Alkan's acquisition by Rio Tinto offers both benefits and challenges, providing valuable lessons on FDI privatization. Some of the benefits included enhanced competitiveness. With Rio Tinto's resources, Alkan improved its operational efficiency and competitiveness, which helped secure a stronger foothold in the global aluminium market. There is also technological and operational advancements benefit, where Rio Tinto's investments brought modern technology, including advanced smelting processes, that reduced environmental impacts and increased energy efficiency. Besides that, another benefit is market expansion. Through Rio Tinto's global network, Alkan expanded beyond North America, growing its revenue in high-demand regions and increasing its global market share. Some of the challenges in the process included objective alignment. There was a need to align Rio Tinto's profit-driven motives with Alkan's Canadian heritage and community obligations. Canada wanted to balance economic growth with public service, especially around employment. Besides that, there is also regulatory constraints. Canadian regulations limited foreign control in areas like employment and environmental standards. Although these constraints sometimes restricted Rio Tinto's flexibility, they were crucial for ensuring accountability. Next, we have public perception. The shift from being a Canadian-owned company to foreign ownership raised concerns, especially about potential job cuts and prioritizing profits over community well-being. This underscores the importance of managing public perception in high-profile acquisitions. The lessons learned here emphasize the need for alignment in motives, clear contractual obligations, and the value of regulatory frameworks in protecting national interests while allowing for foreign investment. To conclude, Alkan's acquisition by Rio Tinto showcases the effective application of FDI insights CE research framework. Alkan's successful transition hinged on legally binding promises, aligned motives, and committed actions across Rio Tinto, Alkan, and the Canadian government. Realizing commitments and balancing private and public interests, Alkan became a competitive entity in markets. This case highlights the importance of strategic FDI partnerships, which not only drive growth, but also preserve alignment with national and public service objectives. This brings us to the end of our presentation. Thank you so much for listening.